Hey everybody, I'm Mike Desepoli and welcome to the Heritage Market Pulse for Friday, August 20th. We hope you had a great week. Markets are wrapping up a very choppy week here on a Friday. I want to discuss a couple of the key points that went on this week that we believe is contributing to the volatility and some of the angst that we're seeing in the markets, and we want to break those down for you here today to bring this whole thing into perspective. So the first thing you have to understand is seasonality in the market. Seasonality, markets go through different trends in different seasons, and August tends to be one of the worst months, if not the worst month, historically on record. People ask, why is that the case? We think it's a lot to do with depressed trading volumes. Many large institutions, traders, and the likes are off on vacation with their mind on other things. So it creates a lot more volatility, these big price swings in the market, more so in the month of August and the beginning of September than through any other months through the rest of the year. It appears to us here that the market is undergoing a little bit of a mini correction, which, as you've heard us speak about this in the past, it's very healthy for market structure. These are the types of moves that you see as market leadership starts to shift from one group leading the pack to another. It's natural to see a lot of choppiness in price action, and we look at the internals of the market. How many stocks are advancing, how many are declining, how many are hitting new 52-week highs versus how many are hitting new 52-week lows, and on and on and on. It tells us that is likely what we are seeing happening under the hood. The big overhang on this market right now is anxiety about the Federal Reserve and what they're going to do with monetary policy. We are constantly talking about the Fed. We are constantly talking about monetary policy, really much more than we would like to be, but this is a very prevalent piece to the puzzle that is the financial markets, and it does us a lot of justice to discuss and dissect what they're doing. So here's what happened this week. We had an event on Wednesday, which was the monthly release of the Federal Reserve meeting minutes, right? So the Fed meets 12 times a year. Not every meeting is followed by a press conference, and the ones that are not followed by a press conference, they release their meeting minutes. Now, it is important to remember, even though these numbers, these minutes were released on August 18th, they are from the July meeting. So we have a significant lag time between when these participants met and when the meeting minutes are released. In the first 2 weeks of August, we have seen some economic reports that are a little bit concerning. They're not showing that robust growth that we've seen through the course of the year. And we saw a big move down in the consumer sentiment index, which indicates investors and retailers alike are feeling some anxiety about the future. Delta variant could very well be a reason for that. So here comes Wednesday, the Fed minutes come out, and they indicate that the committee is starting to consider slowing down the pace of the stimulus that they provide to the financial markets. Naturally, financial markets don't like to hear this. When you start to remove the punch bowl, they become concerned and markets start to get rocky. So we saw that big sell-off on Wednesday and a little bit more on Thursday. Now, people are concerned that with the Fed, they're going to take drastic action and they might put a damper in the economic recovery. When you couple that with the fact that later this month, the Fed will have their annual retreat to Jackson Hole, Wyoming, many market participants and watchers are anticipating the Fed is either going to raise rates or slow up on the stimulus. And I'm here to tell you, we do not see the Fed doing either one of those things this year. This economy is performing well and rebounding, but it is certainly not at a place right now that would be appropriate for the Fed to slam on the brakes. But nonetheless, this will not stop the markets from worrying about it until we get a concrete statement from the Fed, probably sometime around August 28th or 29th, at the conclusion of that Fed retreat. So this is what we believe when you factor in seasonality in the markets, right? August is generally not a good month, low trading volumes with high volatility. We have anxiety about the Fed policy, what the Fed's going to do. Are they going to make a wrong move? Because Feds of the past, 2008, 1987, they had a few calculated missteps that led to a lot more pain in the markets. We believe that this Fed is committed to doing the right thing, whatever that may be, and they certainly don't want to screw up this monetary policy experiment. But again, that's not going to stop market participants from worrying about it. Another thing we want to mention is the level of investor anxiety and fear excuse me, in this market is very, very high right now. The Fear and Greed Index, which is something you can Google online, it's a sentiment survey. And right now, this index is sitting at levels of extreme fear. Now, as contrarian investors, this is a good sign to us. I know it probably sounds counterintuitive. Why is fear in the market a good thing? But generally, the herd, if you will, the bulk of retail investors never see moves coming in the market. So the fact that they are all anticipating a crash, they are all preparing for a crash, they are all scared of a crash, means it is very unlikely that that is how this story ends. We think, on the contrary, this is how powerful rallies begin, because you have people with one foot out of the market, they're ready to take both feet out of the water, and ultimately when the market starts to move, these will be the folks that are missing the rally and chasing it to the upside. So we wanted to come on and talk about this today. We have zero concerns right now about how the markets are behaving, the market structure, and again, let's keep this in perspective. We are maybe 3.5% away from all-time highs right now. So not a reason for concern, not a reason to wave your white flag and bail on a portfolio strategy. We know our investors would never do that, but we're seeing a lot of that when we're speaking to the retail investing public. Everybody is waiting for a crash, and when everybody is prepared for a crash, that is when a crash is not coming. So we wanted to talk with you about this today. What we'll be watching for next week is to see if this volatility continues. At some point, you'll likely get an apex volatility moment where we'll have that really big whoosh down in the market. It'll mark a high point for volatility, which will start to come back down, and that's when we expect to see the markets firm up their footing and start to move higher. So next week we'll be watching for that. We'll be watching these market internals to see where our market leadership is coming from, and ultimately we believe as we work through this seasonally weak period, there are better days that lie ahead. It's still been a great 2021 investment year so far. We have a lot to show for the progress we've made this year, but the work is not done, so we will keep at it and make sure we get across the finish line in strong fashion. If you have any questions, please reach out to us. We're always happy to talk with you about anything that is on your mind. We hope you guys have a great day and a great weekend, and we'll see you back on Monday for the Heritage Market Minute.